Okay, so Chapter 2 is also introductory. We can see here we're getting the building blocks of managerial accounting. We're learning some of the definitions in this chapter, and we're also going to be reviewing the income statement, and as well as applying it to a manufacturer's income statement. So we know there's 3 types of companies: service business, merchandisers, manufacturers. In financial accounting, we started talking about service companies, right? That they earn their revenue by providing a service for a customer. They don't have any inventory. So an example of a real life service company would be H&R Block. They do tax returns for people. A merchandising company, after the first exam in financial accounting, then we started talking about merchandising companies. So a merchandising company buys products from a manufacturer or distributor at one price, and then they mark it up and sell it to their customers at a higher price. So they have one inventory account, just their merchandise inventory account. So a real life merchandising company, that would be any retail store. It would be Target, it would be Walgreens. Okay. Manufacturing companies, they actually make the product. So an example of a real life manufacturing company would be Ford Motor Company. They make cars. And so in financial accounting, we saw the merchandiser had their merchandise inventory account was shown on their balance sheet. For a manufacturing company, their balance sheet is going to show 3 inventory accounts. So they buy the materials they need to make their product, so that's their raw materials inventory. And then they use the raw materials and start putting together the product. So while the product's being made, it's considered work in process inventory. And then when the product is done, it's all the way made, then it becomes finished goods inventory. So we can kind of see the way costs are going to flow through the system. We start off with raw materials inventory, and then when you start working on the product, it becomes work in process. And then when the product is completed, it's finished goods inventory. Okay. Another definition that you'll see in the chapter is the value chain, the activities that add value to the products. Okay? So you'll be incurring costs, and if they add value to the product, then it's possible you can pass that on to your customer. Your non-value added products, such as inspections and testing, they're important because you don't want to sell defective products to your customers, but you want to try and minimize those those costs, because they don't add value to your product. So we've got the research and development, the R&D, design, and then the production, if you're a manufacturing company, or the purchasing costs. You'll have a purchasing department if you are a merchandising company where you are buying the product from distributors. Then you'll have marketing, advertising, how are you going to get customers, distribution, how are we going to get our product to the customers, and then finally customer service. And so those are all things that add value to the product, right? Even you think customer service, if you've ever had a problem with a product and you go and you call, use the customer service hotline, and you get good service, that's going to give you, a good impression about that company, and you want to go back and be a repeat customer. Another definition we have is cost object. What we're going to be doing in the next few chapters, 3, 4, and 5, is going to be focusing on how we come up with the cost of, say, a product. So the cost object is the thing that you are trying to find the cost of. So it could be, as I said, it could be 1 unit of your product. How much does 1 unit cost? It could be maybe we're trying to decide on a marketing strategy. And so you will be putting together marketing plans, right? You'd have that cross-functional team we talked about, looking at the costs of the different marketing strategies. Geographic segments of the business might be looking at the cost of running a specific segment of your business or a department of your business. What are the costs? And so the manager of that department is probably charged with controlling costs for their department. And so when we're talking about a cost object, it can have direct costs or indirect costs. So the direct costs, we can look at the object and know exactly what costs were involved. Indirect costs are part of the cost of the product, but we can't trace it directly to the product. So when we're talking about making a specific product, let's say we're making chairs, right? We can look at the cost of the wood for the chair. We can look at how much we paid the person to put together the chair. Those are direct costs that we can look at that chair. But the chair itself was made in a factory. And what were the costs of keeping the factory going so that we could make that chair? So we can't, trace the cost of the utilities for the plant, the factory, right, to the one specific chair, but we knew we had to incur utilities in order to make that chair. So the utilities would be an indirect cost for that chair. Okay. So let's take a look at an example of direct and indirect costs. So here's a Kohl's store in Medina. I'm not sure exactly where Medina is. Let's say it's in Medina, Ohio. All right, and so the junior department, if you go into Kohl's, there you can buy men's clothes. So there's a men's clothing department, there's a women's clothing department. Juniors would be like teenage girl clothes, right? They also sell, some housewares there. Okay, so there's various departments, and we're just looking at this junior department where the teen girl clothes is. So if we look at the cost of the depreciation on the Kohl's store in Medina, Ohio, that's going to be considered an indirect cost when we're trying to determine the cost of just the junior department. The cost of the costume, jewelry, and the mannequins in the juniors department. Since it's in the juniors department, we can trace that cost. That goes directly to the junior department cost. The cost of the bags used to package customer purchases at the main registers for the store would be an indirect cost. If you've ever been in a Kohl's store, you can get your purchases, you can get something from the juniors department, maybe you go and buy a baby gift for somebody, maybe you go buy a blender, right, and you bring that all to the cash register and then they bag it all up. So the bags are used for all of the departments in the store, so that's why it's an indirect cost. The store manager's salary for that Kohl's store would be an indirect cost. That manager is overseeing all the departments. So it's not just a cost of the juniors department, it's a cost of all of the departments. Same with the security staff at the Medina store. That would be an indirect cost of the juniors department. The manager of the juniors department, that can be directly traced to the juniors department. So that would be considered a direct cost. The junior department sales clerks, so those would, again, they are working just for the juniors department. That would be a direct cost. The cost of the juniors clothing, that is a direct cost to the juniors department. The cost of the hangers used to display the clothing in the store. So there's a whole bunch of hangers. Some of it goes to the men's department, some go to the women, some go to the boys, some go to the juniors. So that would be an indirect cost because the cost of the hangers would really be for all the departments. The electricity for the building, again, that's an indirect cost. It benefits all the departments. Radio advertising for the store, that would be an indirect cost, okay, because it benefits the entire store. The juniors clothing buyer's salaries. Now, this has to do with juniors. However, the clothing buyer would be the person in the corporate office, right? Kohl's corporate office is in Wisconsin. So there's somebody who is the corporate buyer for all of the juniors departments. So they pick out which fashions and what have you they want in their stores. And so this would be an indirect cost of the Medina location because the person in the corporate office is buying the juniors, picking out the juniors fashion for the Kohl's stores all throughout the country. So it would be an indirect cost of the juniors because it's of the juniors department in Medina, because it's actually being incurred for all the junior stores. Another thing that's going to be really important is distinguishing between product costs and period costs. So product costs are all the costs that are incurred for a product. So the materials, the salaries, all the indirect expenses. And so any of your product costs are going to be an asset on your balance sheet. So on our balance sheet, we know if we first show our assets, our current assets are those assets that we're going to use up within a year. We've got cash, we've got accounts receivable, and then we can see we've got raw materials inventory, work in process inventory, finished goods inventory. So those product costs are going to be recorded in these accounts. Okay. When they get sold, they're going to show up on the income statement as cost of goods sold. When you sell your finished goods, it becomes part of your cost of goods sold. So our product costs, if you're a merchandiser, you just have your merchandise inventory account, and that's going to include the purchase price, whatever you had to pay to buy the merchandise inventory. If you had to incur any freight charges, that becomes part of the cost of the inventory. And then we didn't talk about this in financial accounting, but if you're buying them from another country, you have to pay import duties or tariffs when you're acquiring the inventory. And so our product costs, our direct costs would be direct materials and direct labor. Our indirect costs are considered manufacturing overhead. So our manufacturing overhead, right, are the costs that we can't directly trace to the product, but they're part of the manufacturing process. So anything that has to do with the plant, okay, other than direct materials and direct labor, is manufacturing overhead. So your indirect materials, that would be, let's say we're making those wood chairs, sandpaper that you're using, because you're using that on various chairs. You're going to be sanding the wood. Maybe it's going to be 3 or 4 chairs, right? So it's going to be an indirect material. It could be glue. You're just grabbing some glue out of a vat of glue. That would be an indirect material. Indirect labor would be the labor that's not the labor on actually putting together the product. So the manager of the plant, that salary, you can't trace it to a direct product. He's not involved in a direct, in making a specific product, but that plant manager salary needs to be incurred in order for the manufacturing to take place. The janitor's salary, right? You need to have the janitor working in the plant or you wouldn't be able to make products. So that's considered a product cost, a manufacturing cost, indirect labor. Other indirect manufacturing costs, so the depreciation on the plant, or the equipment depreciation, the utilities for the plant, the depreciation, I've already said that one, the property taxes on the plant, right? Those are your other indirect manufacturing costs. Those are all considered manufacturing overhead. Then we have period costs. So these are the costs that are not manufacturing. They don't have to do with the plant. So these were the things that we called operating expenses back in financial accounting when we were talking about merchandisers. So our selling expenses are general and administrative expenses. So on our income statement, right, we have our sales revenue. We subtract our cost of goods sold, which is the cost of the finished goods that we've sold. We get our gross profit, and then we subtract our operating expenses. These are going to be the selling expenses, such as our salespeople's salaries, our advertising expense, and our administrative expenses, so our office people's salaries, the rent on our office, right? If we had rent on a plant, that would be a product cost, but rent on the office is going to be a period cost, an operating expense. And it's called a period cost because it's deducted in the period that it's been incurred. Your product costs become asset. They go into the inventory accounts. They're asset accounts when they're incurred. They do not get deducted on the income statement until they are sold. So that's the difference between period and product costs.